So he asked if what is the difference between a Form 8821 and 2848?
Oh, yeah, entirely different. So 8821 is an information authorization where it allows us to pull records from the IRS. So usually those could be transcripts. So there's a system in the IRS where you can upload these authorizations and you spell out like what years and what forms is the tax professional authorized to look at. 2848 is a representation form. So that's the authorization for this tax professional to talk to the IRS on your behalf. So 8821 is read only, 2848 is talk to and receive. So that's the difference between the two forms. So that one it doesn't depend. That actually has an answer.
All righty. So we have another question that just came in. Which three strategies should I be focused on mastering right now if I decide to do my own planning?
Yeah, I mean, it kind of goes in order. So the first thing you want to get your hands around is entity selection. So what are you doing? Why are you doing it? What's the right entity for that? So it could be, our usual approach is LLC. So LLC is a legal wrapper, but it's not a tax status. So LLCs can be taxed as a disregarded entity, in which case you just file a Schedule C. And that's saying you and the company are the same person when it comes to taxes. It could be a partnership. It could be a S corporation. It could be C corporation. Also, or do you need a corporation, or do you need a PA, or do you need a whatever, an LLP, for example? First that's your first decision is what entity is right for me and what I'm doing in my particular circumstance. From there, and when I say entity, I mean taxable entity, because again, the legal wrapper around it could be different depending on what you're doing. But those are the basics: disregarded entity, partnership, S corp, C corp. There are some other variations, but not applicable to 99% of people. So that's number one. And then from there, the next thing to do is to figure out, probably number two is going to be accountable reimbursements. So accountable reimbursements, an accountable plan. If you ever worked for a company and you went out and you went on a business trip and you spent stuff and you had to hand in your receipts and the company reimbursed you, that's an accountable plan. The accountable plan is, especially for small business, is built to reimburse you, the owner, or you, the employee, for business expenses that you have that you're already incurring personally. And so, there's a lot of work to be done there, but, it could be home office stuff, it could be car stuff, it could be travel, it just depends, right? So that'd be number two. And then number three, I would say would be compensation optimization. So that's usually what we do last, actually, but it is a big mover at that point because we were just on a call with a client talking about QBI. So QBI is qualified business income. And the tax code currently from the Tax Cut and Jobs Act, it has what's called the qualified business income deduction. And this is a break or a discount or a deduction on qualified business income that you receive from pass-through entities. Could be Schedule C, could be Schedule E, could be Schedule F, could be S Corp, could be a partnership. Any of those can create qualified business income. And then you could get up to 20% deduction on that income. So if you have $50,000 of profits from one of those, you might only be paying tax on 40 of it. And so it's a big deal, right? Getting 20% off of your income. And the bill that's in Congress right now is talking about raising that from 20% to 23%. So that's the whole thing. So number one, entity. Number two, accountable to reimburse yourself for money that you're already spending personally and lowering that taxable income. Number three, I'd say compensation optimization to make sure that you're doing things in order to maximize things like the qualified business income deduction while maintaining compliance with other regulations depending on the entity type. And then once you have compensation, then that also brings into the picture any kind of retirement planning you want to do for solo 401ks or whatnot. Most of the time, solo 401k is going to be the most efficient retirement planning strategy. And so those would be the first three to look at.